Hey everyone, and welcome back to the channel. Today, we're diving deep into a question on many investors' minds. Can Singapore's three banking giants, DBS, OCBC, and UOB, truly hit new all-time share price highs in 2025? These banks aren't just big names, they're the bedrock of Singapore's financial sector and hold massive weight in the Straits Times Index, so their performance is a critical barometer for the entire market. Let's break down the complex interplay of challenges and strengths they face. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. As of late June 2025, all three banks are trading below their recent all-time highs on the Singapore Exchange. DBS is about 4.49% below its peak, OCBC 8.81% below, and UOB 8.16% below. For reference, DBS's SGX all-time high was 46 Singapore dollars and 97 cents on March 28, 2025, which also coincided with the STI hitting its own all-time high of 4,005.18 points. OCBC and UOB reached their recent highs on February 19, 2025. So, while not immediately certain, those peaks aren't too far off if conditions align. Let's look at their recent financial performance from Q1 2025, and here we see a mixed but largely resilient picture. Net interest margins under pressure. A major headwind is the compression of net interest margins. This is a direct result of falling interest rates, specifically the Singapore overnight rate average, which eased by 51 basis points in Q1 2025 to 2.56%. DBS's NIM narrowed, OCBC saw a sharper decline, and UOB's remained stable. This directly impacts their core lending profitability. But here's the silver lining: resilient non-interest income. This is where these banks truly shine. Wealth management fees and trading activities were massive drivers of growth, significantly offsetting the pressure on NIMs. DBS saw a phenomenal 22.2% year-on-year increase in fee income, driven by a 39% surge in wealth management fees alone. This shows their successful diversification away from being solely reliant on interest rate cycles. Asset quality and prudence. While non-performing loan ratios remained stable across all three banks in Q1 25, DBS at 1.1%, OCBC at 0.9%, and UOB at 1.6%, they all adopted a prudent approach by setting aside sizable allowances. This proactive provisioning suggests they anticipate potential asset quality deterioration in the second half of 2025, especially given rising macroeconomic risks and property-related concerns in Greater China. This is a necessary step for risk management, but will naturally temper reported net profits. Commitment to shareholder returns. Despite some flat or lower year-on-year net profits, DBS and OCBC demonstrated a strong commitment to shareholder value. DBS maintained its dividend and introduced a new capital return dividend, plus a 3 billion Singapore dollar share buyback program. OCBC plans to return 2.5 billion Singapore dollars in capital, and UOB declared a special dividend and a 2 billion Singapore dollar buyback. This attracts income-seeking investors and signals management's confidence in their financial strength. Their strong capital positions, with high CET1 ratios around 15.2% to 15.5%, provide the necessary buffers for these initiatives. However, do note that the global minimum tax is explicitly mentioned as a factor reducing net profit for DBS, which could affect future payout capacity. Now let's zoom out to the broader macroeconomic environment. Singapore's economy, being small and open, is highly susceptible to global shocks. Cautious GDP growth. The Ministry of Trade and Industry forecasts Singapore's GDP growth for 2025 at a moderated 0.0% to 2.0%. This slowdown is largely due to weakening global demand and persistent trade uncertainty, particularly from U.S. tariff policies. Falling inflation and easing monetary policy, inflation in Singapore has fallen significantly, with mass core inflation easing to 0.7% year-on-year in early 2025. In response to the weakening outlook and easing inflation, the Monetary Authority of Singapore has actually eased its monetary policy twice in 2025. The SORA is also projected to trend lower, potentially below 2% in 2025, which will continue to impact banks' net interest margins. This challenging external environment creates headwinds, but the bank's diversified income streams and strong capital positions provide a crucial buffer. The regulatory landscape in Singapore is also dynamic, largely shaped by MAS. And this has direct financial implications for the banks. Increased compliance costs. We're seeing an enhanced focus on anti-money laundering and counter-financing of terrorism efforts. There's also increased scrutiny on environmental, social, and governance, or ESG risks. And in the digital asset space, MAS has issued guidance on assessing and verifying wealth from digital assets, requiring banks to invest in sophisticated approaches like on-chain screening. The financial impact. These regulations mean increased operational costs for technology upgrades, talent acquisition, and compliance processes. As mentioned earlier, the global minimum tax is also noted as reducing net profit for DBS. While these measures add costs in the short term, they are crucial for maintaining financial integrity, Singapore's reputation as a clean financial hub, and the long-term stability and resilience of the financial sector. The banking landscape is also undergoing a significant transformation due to rising competition, particularly from digital banks. Rise of digital banks in GXS Bank, backed by Grab and Singtel, and Trust Bank, a joint venture between Standard Chartered and Fair Price Group. Trust Bank, for example, captured 20% of Singapore's retail customers in just over 2 years, becoming the fourth largest retail bank by customer count in early 2025. These digital-only players offer seamless, mobile-first experiences with lower fees and personalized solutions, targeting specific segments like the unbanked or underbanked. Traditional banks' response. Our incumbents aren't sitting still. They're accelerating their own digital transformations, launching digital banking arms, investing heavily in AI-driven customer services, and leveraging open banking frameworks. They're adopting a phygital approach, modernizing IT, refocusing on the customer journey, and capitalizing on their vast existing customer data with AI-powered insights. This competitive pressure, while posing a threat to market share, is also a powerful catalyst for innovation within traditional banks. It pushes them to evolve, which is essential for long-term growth and share price appreciation. So, what are analysts and investors thinking? Sentiment is cautious yet generally supportive. Analyst ratings. While there are varied recommendations, the sector is broadly seen as providing attractive value with a low price/book and a high dividend yield of 6.5% for 2025, appealing to income-seeking investors. Market activity. The Straits Times Index saw upward momentum in early 2025, partly driven by financial stocks. However, concerns over U.S. tariff threats led to some profit-taking and sustained institutional net outflows. Safe haven and confidence. Despite these concerns, Singapore's status as a safe haven financial hub with high dividend yields and economic resilience continues to attract capital inflow. The significant share buybacks by DBS, UOB, and OCBC in April 2025 also signal management's confidence and commitment to returning capital to shareholders, which can bolster investor sentiment. Remember, the STI's ability to cross the 4,000-point mark again heavily depends on these three banks. In conclusion, the prospect of Singapore Bank's share prices hitting new all-time highs in 2025 is definitely nuanced. Challenges are real. We're talking about a macroeconomic slowdown, persistent NIM compression, emerging asset quality concerns requiring proactive provisioning, increased regulatory costs, and intense competition from digital banks. But their strengths are formidable. They have resilient non-interest income, especially from wealth management. They boast robust capital positions and a strong commitment to shareholder returns through dividends and buybacks. They're strategically adaptable, embracing digital transformation, and Singapore itself retains its safe haven status. Plus, they are already trading relatively close to their recent peaks. The analysis suggests that while a rapid surge to significantly new all-time highs may be less probable, a gradual, sustained appreciation driven by fundamental performance and capital returns is a more likely scenario. The key will be their continued ability to leverage diversified income, manage credit risks effectively, and keep that strong commitment to shareholders. So, for investors, keep a close eye on global trade developments, interest rate trajectories, and especially the growth of their non-interest income. Their resilience and strategic foresight position them well to navigate this challenging environment and potentially surpass previous peaks, but it will be a testament to their operational strength rather than just a broad market re-rating. What are your thoughts on Singapore banks? Let us know in the comments below. Don't forget to like this video, subscribe for more insights, and hit that notification bell so you don't miss our next update. Thanks for watching, and we'll see you next time.